All right, everyone, let's do a May 2021 market recap. I want to start with FinViz. This is where I'm going to really want to start pretty much every single one of these videos going forward, mainly because you could really see how this is playing out, right? So we've talked for months on end, no, probably over a year now. So, probably over a year, we've been talking about the rotation into value from tech. And better early than never. But you could really see here just what is happening from sector to sector, industry to industry. So, this is a year to date performance. Google and Facebook have essentially decoupled from FANG. So Amazon hasn't moved all year long. Apple down a little bit. Microsoft up a little bit. Tesla down a little bit. You could see software starting to get hit pretty hard. Down 30%, down 28%, down 39%, almost 40%. So you're seeing a lot of these, getting hit pretty hard since the beginning of the year. And then on the flip side of that coin, you're looking at banks like JP Morgan, Bank of America up 30, 41%, Wells Fargo up 55%, ExxonMobil 47. And then some of my favorite ones is really the small caps. So normally I use this ETF, PSCE, Small Cap Energy ETF, and the reason, you just take a look at this, completely left for dead, right? So tons of volume coming in over the last year, just massive amount of volume. This thing has completely bottomed out. No investors left. Nobody wanted energy. And now it doesn't take a lot of money coming out of tech to really boost energy up. So this PSCE is a great ETF to play the small cap energy sector. But names like RIG, which is Transocean, if you like HP, doing great, CPE. I feel like some of the bigger names like Schlumberger, Baker Hughes, just absolutely crushing it right now. MRO crushing it. CLR. I can pull up anything right now in energy, and it is just absolutely crushing. So the large cap, mega cap doing really, really well, and it's the small cap, mid cap doing extremely well as well. So you can't miss with this rotation. You could buy the ETF and play the whole entire industry, industry or sector, or you don't, and you just go individual names and you do pretty well, right? So look at Schlumberger up 62.44%, Halliburton up almost 30%. Some other names up some pretty ridiculous numbers, so you get the gist of it, right? So the rotation, we've been tracking for quite a while, and the best way to track it is with these Bank of America Global Fund Manager surveys, the positioning, the Z-scores, which pretty much means, where is the current weighting of a particular industry or sector versus the historical mean. And in this case, as you can see, May 2021, commodities gutted again, so big move into commodities, banks, materials, industrials. Energy keeps moving up. Energy for years was the bottom right down here. Just nobody wanted it. Just kept getting sold. So the money could go into tech. So the money could go into healthcare. So on and so forth. So energy is moving its way up the positioning ladder, which is great. Bonds continue to get beat up. Tech down here, which has been waiting for that for quite a while. And so we're finally starting to see value play out pretty strongly. And you could see, I think I may have showed you, April was a flip. So April was like this is the totals positioning versus Z-score. I think the one for April I had showed you that they had flipped for that month. So they were putting money back into tech, back into bonds, back into places that it's always been. And then it flipped right back in May in a very big way. March, again, commodities. February, commodities. So you could just see that industrials, energy. So you could see that, first it was rotation in motion, right? I was showing you back in last year, 2020, that hey, small caps are getting a look, values getting a look, tech, cash, bonds getting sold off. So this was all the way back in August. I'm showing you these global fund manager surveys, and you're really starting to get a feel for, hey, is this really happening, right? But you know, a rotation takes more than a month, it takes more than a quarter, and heck, it takes more than a year or two. So we want, you want to see this keep up. There's going to be peaks and troughs to this. You want to see this really trend over years. So we're going to see if it holds up. And this I've showed you 100 times, but this really should have. This is never going to leave my presentation. This was back in 2019, early 2020, and when you get to these types of extremes, I don't care. I don't care if you think the shiny object tech can't go down. It will go down at some point. So, but why, right? Why? Like what causes that? And I thought one of the most interesting things that I saw over the last couple weeks was this article right here. And so this article says a $16 billion quant ETF is poised to reshuffle 68% of the portfolio. MTUM is the ticker. It's Momentum Factor ETF. The basic principle behind it is that it's a fund that basically just latches on to anything that's moving up. So if it's a monthly or quarterly kind of reallocation, rebalancing that it does to kind of latch on to momentum, which has normally been tech. So tech outperforms everything during a month or a quarter, then it latches more onto tech. It does it again, it latches more onto tech. So that's been happening for the better part of a decade. And finally, you're starting to see that, well, once financials outperform, we'll go back to FinViz here. Once you have financials outperforming, industrials outperforming, energy outperforming, basic materials outperforming, so on and so forth, well, now these momentum funds are starting to latch on to the value sectors. So this is a massive rebalance that had happened. You had technology that was 40.3% down to 17.1, a 23.1% difference. Just a massive reshuffle, and a lot of it. The reshuffle from financials, it was 1.6 and went up 31.7%. Energy had a zero position, zero. Now it's 2%, right? And what doesn't get, this one old from materials 1.8%, new is 3.6%, 1.8% difference. The materials and energy that's barely anything, right? But it's so significant to start seeing it move in that direction, because we haven't seen it move in that direction in a very, very long time. Industrials also had a really nice move in this fund. So okay, so why does that happen though, right? And we talked about, and I keep using Amazon as an example, and you can just look, if I were to go year-to-date performance, Amazon's at negative 0.7%. So what's going on with Amazon? It had like a couple of the best quarters it's ever had. It keeps making money hand over fist. We literally can't stop ordering from Amazon. Their software, they're buying up companies. They're going to be in every single aspect of our life at some point. So why has it just gone sideways? And the answer to that question, not entirely, but somewhat, is that you just can't put any more of it in your portfolio. You've spent the better part of, let's call it, 13 years dumping energy, dumping materials, dumping this, that, and the other thing, and putting it all into Amazon, because Amazon is the best, right? Amazon is one of the best run companies in the world. They make tons of money. They have a gigantic moat around their company, around their business models, like nobody can break through. They make moves, if you've ever read anything on Amazon, they make decisions today that won't go into effect 5 to 10 years from now. Like they're so far ahead, it's impossible for anybody to catch up. But that's like kind of the, when you look at the macro economic environment, or if you look at some of the microeconomic factors that go into Amazon, all of that looks good, right? But what a lot of people don't understand is that on the other side of that coin is investment dollars. And you can't just put all of your fund's money into Amazon. You can't just put a whole entire pension fund into Amazon, right? Like you can't put a hedge fund all in on Amazon. You can't put mutual funds, ETFs, whatever. So at some point, everybody's all in. And what does that mean to be all in? It means that you no longer can increase your exposure to Amazon. And so you have to just hold, or you have to just start selling a little bit and taking profits. And so now that what that really means is that you lose buyers, and now you just got sellers. So a lot of people right now don't really give a crap, right? They've made all, like, let's say you bought somewhere in 2012. Let's say you were that lucky, right? You bought in 2012. I forget if it's split a couple times since then or something like that. So you're making out like a bandit, right? And so somebody who bought over here 2012, 2013, 2014, 15, 16, 17, they don't give a shit. Like, right? They don't care that it's going sideways. They've seen this before. You know, they've seen Amazon go sideways for a couple of years. Whoop-de-doo. No big deal, right? Every stock needs to go sideways for a little while. Look from 2014 to 2015, sideways to down, right? So stocks do that. So all the people down here aren't worried. All the people here aren't worried. All the people on here aren't worried. But again, the longer it lingers, right? The longer it lingers, all of the performance tracking ETFs, all of the momentum factor ETFs, all of the funds and hedge funds that latch on to like these momentum stocks. Well, Amazon doesn't have momentum anymore. And so if you see a fund start dumping tech or start dumping consumer discretionary, right? Or consumer internet retail or whatever, they're dumping it, right? They're getting rid of it. Well, if they're doing that and they're moving into financials and they're moving into industrials and they're moving into energy, well, sooner or later, this is going to start cracking, right? You're going to start, more and more people are going to be taking their piece of the pie of Amazon. And so you need to be wary of that, because the more this kind of goes sideways and drips, the more and more momentum funds like this MTUM are going to stay away from it. They're going to latch onto something else, which means that's even less buyers for Amazon, right? And that means that's gonna essentially create more sellers. So you have this big gap in the profile, which, oh boy, just like this got really fast on the way up from March 2020 to August 2020, this thing was up 116%. That is extremely impressive, right? So in less than a year, 5 months, up 116%. But it's going sideways ever since. So while this has been going sideways, everything else has been getting the investment dollars. But to think that, you look at something like an Exxon that since August, right? So August to now is up 56%. Or year to date, where's Exxon? Up 47%. So Amazon can go sideways and Exxon can gain 50%. So I want you to really think about that in opportunity cost. You want to go ahead and grab Amazon, try for a last gasp, right? Like, let's see, if this was an actual pattern, that's like we'll call it a 700-point move from breakout, if it is a bullish pattern, which it really isn't. It's really just a range, right? Looks like equal highs, equal lows, just completely range bound. But a 700-point move from breakout, would take you somewhere in the 4,200 range, right? So 20% higher. So, do you grab it now? I've been saying this in my videos lately. You get the last gasp from Amazon, right? You get that last move up because, you know, you look back at like a Microsoft, right? You know, maybe this is Amazon's consolidation and it has one last gasp up, right? Well, do you want to play for that? Is that where you want to put your investment dollars? Is that where you want to put your trading dollars, your trading capital? You want to try for that last little move? So, you know, I use Amazon as an example, but look at Apple. Apple's not much different, you know, different pattern, right? Because you got higher lows going on. So higher lows, that's at least a little bit more bullish. Higher highs, right? So that's a little bit more bullish. So maybe this kind of just grinds up, right? I don't think it will, but I think I was also wrong about tech, probably all the way through here. I was probably wrong about tech. So yeah. So, you know, that's why this looks the way it does. And you look at like the 1 month, you know, again, just, you know, Exxon was up a little bit, you know, Amazon was down a little bit, but you have some really, really strong areas of energy here. I think the mid and small cap outperformed the large cap pretty handedly in May. So, you know, just keep that in mind. You know, the other thing to really think about too is that and I've mentioned this plenty of times before too, but look, you're late, right? You feel like you're late to the party. Let me just take I'll just take a rig or something like that. It's not the best example, but, you know, rig is up probably, you know, 300-400% from its bottom, but you look at this chart and you say, whoa, we haven't even gotten started yet. And you look at things like CPE, you know, and you look at this chart and you say, whoa, you know, yeah, great move off the bottom. That's always 10x off the bottom right now, but you're still, from this point, if you were to buy it today and it were to go all the way back to all-time highs, that's another call it 500%. And that's not even considering if it were to take out the highs. You know, we look at charts like the SOX, like the semiconductor index, and, you know, once it breaks out, huge move, and then look at, right? So then it has this huge move and then spends all this time down, breaks out, and then look what happens when it breaks out. So I know it's impossible to think about. I know you're right now you think that there's no way, with all the bills that Congress is proposing and all the pressure on oil and gas to switch to renewable energies and all that stuff, you think that there's no way oil and gas companies are going higher. And it doesn't matter. It has everything to do with investment dollars. And what a lot of people don't realize too is that, look, if you stop ExxonMobil from investing in more infrastructure or more capex, because you're essentially forcing them in all the different ways you can force them into renewable energy, and demand for energy increases whatever percent year over year, plus whatever the stimulus kind of amps that up, right? So you have your economy, you know, booming, which means energy demand is going to boom, but then you're constraining supply for the most abundant energy source that we have, and that is going to increase oil prices, right? So if oil prices are going to increase, and a company like ExxonMobil is just they're not gonna spend on capex, capital expenditure, that just means they're gonna make more and more money, and maybe they do share buybacks, right? You know, they're not gonna put it towards increasing supply. So what everybody kind of doesn't fully think through when thinking of renewable energy is the way you go about implementing it. It's like, yeah, we get it. Renewable energy and solar and wind and all that kind of stuff and clean energy. And yeah, we love it. Like, that has to be the wave of the future so we don't destroy our planet. Yeah, but the problem is it's not efficient enough right now. And you can't get enough of it. And there's not enough money being pumped into it. So the problem is that, let's say you were to tell every single oil and gas production company that, hey, you can no longer find new spots to dig, and you can't build new oil rigs, and this land has to remain pristine and all that stuff, and that's fine and good and dandy, and that's going to help save the earth. But on the flip side of that is that you're constraining supply. And if you constrain supply, that means oil prices are going to go up because demand is going to increase, because last time I checked, we introduced trillions of dollars of stimulus. So ExxonMobil is going to have no issue being told, hey, you cannot increase your supply. You cannot spend on more capital expenditure, but, have fun making more money per barrel of oil, okay? You keep making all that money, and, we're not going to stop you from doing buybacks or anything like that. And so it just creates, the whole idea that you're going to force these companies into renewable energy is a really, really bad idea. You want to force these companies into renewable energy? Invest in other companies that are doing renewable energy. And then sooner or later, ExxonMobil will have to jump in. You can't get a company that's been around for like 100 years to just stop doing what they've been really good at for 100 plus years, right? You just can't. So that's a little bit of a rant for you on hey, Kyle, that yeah, it was a good run in energy, but it's going to end because Congress, or it's going to end because yada yada yada. It's like, no, it is not, because again, renewable energy not only has to catch up to current demand, but it has to catch up to future demand, and that means both more investment dollars into renewable and clean energies, and the efficiency has to go up at the same time, and the infrastructure. So what's really interesting too is you hear about this infrastructure package. Yeah, this infrastructure package needs to be about 10 times bigger. It needs to be 10 to 20 trillion dollars, and that's, in my mind, that's the only way you're going to force and produce enough clean and renewable energies. That's the only way. Because if you do a trillion here and a trillion there, and it's not enough to catch up to current demand, well then it's just slow. It's going to be a slow process to really switch over to renewable and clean energy for good. So yeah, so that's my rant. Hope you guys enjoyed that. I think I may have showed you this before, may not have, but correlation between growth and value versus the S&P 500. What this just means is that, like, if the S&P goes up a point, how much does growth and value go up, right? And if growth is the only one going up and value's not, then the correlation is very low. So what you're seeing here is that as the S&P is going up, the correlation was extremely low, just like it was back in 2001. So just there's 100 different data points out there to, hey, I know you had a really fun run in technology over the last 10 years, but believe me when I say this, that run's going to end, and just shake that out of you because you're missing life-changing money getting into this stuff. Now, I do options, so it's like, it's different for me, and it's been really good recently. But if you were able to buy and hold for the next 10 years at any of these prices, your retirement would be looking really, really good. So those are just some, little bit of a May recap plus a little bit of a energy rant. But, if you're still not comfortable with energy, that's only one portion of kind of the value basket, right? You still have financials, you still have industrials, you still have basic materials. Those are all going to benefit from stimulus, from growth, from inflation. Those are all going to be the places to be. And yeah, again, I really can't stress this enough. You look at like not a year performance, year to date. Actually, you know what? 1 year performance is really fun to look at because look at that. Everything's green, right? Because the low was 15 months ago. So just about everything is green from that point. But when things started rolling and switching over, it looks like this. So, but yeah, you see that a lot of these favorites, TTD down 27%, Unity down 39%, Coop down 30%, Pay something. I forget if that's Paycom or something like that, down 30%. Yeah, so you know there's still some bright spots, and a lot of the mid cap, small cap software can still kind of shine, right? Can still do pretty good. But some of the ones that already were flying high flew a little too close to the sun, and now they're kind of getting burned. So solar is getting absolutely mauled. You know, you look at like TAN. So, okay, Biden's president, so time to invest. Or once you know, you can always tell who's going to be the president by like if they support solar, and then all of a sudden a couple months before the election, solar's ripping. It's like, okay, Biden's going to win. So from March 2020 to the top, TAN, which is Invesco's solar ETF, was up, let's call it 475%, right? So you had yourself in about 9 months up 475%. Well, now you have to deal with a little bit of the drawback, right? And so from the top, you're down about 37% right now. It's probably going to take out this low. And I don't know how slippery this could get, to be quite honest. It looks like it get pretty slippery. If you look at a sentiment chart, right? Sentiment chart. So if you look at a sentiment chart, oh, stop it. I hate when it does that. Okay. So you look at the sentiment. Oh my God. Blow it up, will you? It's going to be a better one. Whatever. We'll use this one. So if you can, look really closely. So, okay, everybody is in, everybody thinks it's going to the moon, and then all of a sudden it collapses. And then you get this period right here where it's panic, discouragement, wall of worry, and then this right here. This is the key. Aversion. Aversion. So, let's look at TAN. So you had your enthusiasm, you thought everybody was in, everybody was happy, we're going to the moon. That was, you know, back in 08. Pow, crash. Okay. You had your first crash, you had panic, you get a little bump up. Oh, there's your little bump up, and then pow, right back down. Not done yet. Discouragement phase. The discouragement phase always takes a while. You know, depending on the size of this discouragement phase could take quite literally forever. Another good example of something like that is like a juniper. You look at like juniper on a monthly. Check this thing out. Oh my goodness. So this, because this is so big, so drastic, so unfriggin' believable, this tends to be longer. So back to TAN. So, okay, you got your panic out of the way, your discouragement out of the way, you have your wall of worry out of the way. Now you're getting your aversion out of the way. And so the question is okay, where does this aversion end up? My thought behind that is that aversion is probably going to end up somewhere in this box. So somewhere, so I don't know if we have another 50% to go from here, another 25% to go, but solar's in a tough spot right here. You know, it could get maybe it gets a few weeks up or something like that, but I'll tell you what, it doesn't look good. This is an ugly looking chart, and if it is going to play out like the sentiment chart, then aversion should be coming back in around the 30-40 mark. And again, I get it. Like, that doesn't seem right. It doesn't seem to make sense, but that is likely what's going to happen. So So yeah, so that's how I feel about solar. So that's why solar, if you look at this on a yearly, it's just getting just absolutely murdered. So good to stay away from that for a little bit longer. Again, if you want to play the sector, the industry, I mean, like really target that between 40 and 50 area for a long-term investment. Obviously, solar is getting more efficient. It's going to get a lot of investment dollars. The government's going to back it. So, like, a lot of bright spots for solar, but the problem is, just freaking look at this thing. So, if it is going to play out like the sentiment chart, then 25 to 50% down from here minimum. Alrighty then. Hopefully that was helpful. That is the May 2021 recap. As always, if you have any questions, shoot me an email. I'd be happy to answer. Take care.